So now we're going to take a look at the income statement. Now, the purpose of the income statement is to summarize the profit-generating activities of a company that occurred during a particular period in time. It's a change statement in that it reports the changes in shareholders' equity, which is the retained earnings, that occurred during the period as a result of revenues, expenses, gains, and losses. The components of the income statement usually are classified or grouped according to common characteristics. So a common classification scheme is to separate operating items from non-operating items. So we do it in Dress-Right's income statement, as you see here. Companies like Dress-Right that sell products often report a subtotal with an operating income. So you see here, sales less the cost of goods sold is called gross profit. The income statement for Dress-Right Clothing Corporation for the month of July of 2018 indicates a net profit of $2,917. Dress-Right's a corporation and subject to the payment of income tax on its profits. We ignore this required accrual here and address it in a later chapter. But a common classification scheme is to separate operating items from non-operating items, like in this income statement. Operating items include revenues and expenses directly related to the principal revenue generating activities of the company, while non-operating items include certain gains and losses, revenues, and expenses from peripheral activities. So for Dress-Right Clothing, rent revenue and interest expense are non-operating items because they don't relate to the principal revenue generating activity of the company, which is selling clothing. The statement of comprehensive income extends the income statement by reporting the change in shareholders' equity during the period that were not a result of transactions with owners. So a few types of gains and losses called other comprehensive income, or we call it OCI, or loss items, are excluded from the determination of net income and the income statement, but they're included in this broader concept of comprehensive income. So this comprehensive income can be reported in one of two ways. It can be reported in a single continuous statement of comprehensive income or in two separate but consecutive statements. In the single statement approach, net income is a subtotal within the statement, followed by these other comprehensive items, culminating in a final total of comprehensive income. In the two-statement approach, a company presents an income statement immediately followed by the statement of comprehensive income. Now, the second statement begins with net income as the first component, followed by OCI items to arrive at the comprehensive income. Next, the balance sheet. The purpose of the balance sheet is to present the financial position of the company on a particular date with an organized list of assets, liabilities, and shareholders' equity at a snapshot in time. Now, most balance sheets are classified according to common characteristics. The very first group you're going to see is current assets, and the first liability group will be current liabilities. Now, current assets are those assets that are cash that can be converted into cash or will be used up within a year or the operating cycle, whichever one is longer. Current liabilities are those liabilities that are going to be paid off or satisfied within 1 year or in the operating cycle, whichever is longer. So for a manufacturing company, the operating cycle refers to the period of time necessary to convert cash to raw materials, then raw materials to a finished product, and the finished product ultimately to a receivable. And then finally the receivables back to cash. For most companies, the operating cycle is less than a year. Now, examples of assets not classified as current assets include property and equipment and long-term receivables and investments. Any liability not classified as current is classified as long-term. Shareholders' equity lists the paid-in capital portion of equity, which we call common stock, and retained earnings. The income statements are tied into the balance sheets through retained earnings. Specifically, the revenues, expenses, gains, and loss transactions that make up net income in the income statement are ultimately, at the end of the period, closed out to retained earnings. So here we're going to see an example of a balance sheet. As you see here, the income statement we looked at in earlier slides ties into the balance sheet through retained earnings. So the revenues, expenses, gains, and loss transactions that make up net income in the income statement, the $917, get closed out to retained earnings. Now, during the month, retained earnings, which increased by the amount of net income and also decreased by the amount of the cash dividends that we paid out to shareholders of $1,000. So the net effect on those changes is an increase in retained earnings from 0 at the beginning of the period to $1,917, which is the $2,917 minus the dividends of $1,000 at the end of the period, and also is reported in the statement of shareholders' equity. So this slide for statement of shareholders' equity gets explained in an upcoming slide. The purpose of the statement of cash flows is to report the events that caused cash to change during the period. So it gets classified into operating activities, investing activities, and financing activities. As you see, operating activities are inflows and outflows of cash related to transactions entering into the determination of net income, while investing activities involve the acquisition and sale of long-term assets used in the business and non-operating investment assets. Finally, the financing activities involve cash inflows and outflows from transactions with creditors and owners. So this would be borrowing money or paying the loans back. It would involve issuing stock, or it would involve paying out dividends. So, as this is the first period of operations for this company, the cash balance at the beginning of the period is 0. The net increase in cash of $68,500 then equals the ending balance of the cash disclosed in the balance sheet. There are generally accepted formats that can be used to report operating activities. We call one the direct method and one the indirect method. This slide shows the direct method of reporting the cash flows. The final statement is the statement of shareholders' equity. Also, it's a change statement because its purpose is to show the sources of the changes in the various permanent shareholder equity accounts that occurred during the period, from investments by owners, distributions to owners in the form of dividends, net income, and other comprehensive income. The individual profit-generating transactions that are causing retained earnings to change get summarized in the income statement. So the statement of shareholders' equity only shows the net effect of these transactions on retained earnings. In this case, an increase of $2,917 gets reported as net income. Also, the company paid its shareholders a cash dividend that then reduced the retained earnings. So the final two steps in the accounting process are closing the temporary accounts, remember the income statement accounts and the dividends account, and preparing a post-closing trial balance. So the closing process serves two purposes. The temporary accounts, revenue, expenses, gains and losses get reduced to zero balances, ready to measure activity in the upcoming accounting period. And then these temporary accounts are closed to retained earnings to reflect the changes that have occurred during the period. Sometimes we use an intermediate step to close the revenues and expenses to something, a temporary account called income summary, and then income summary gets closed out to retained earnings. The use of the income summary account is really just a bookkeeping convenience that provides a check that all temporary accounts have been closed out, so the balance equals net income or net loss. The adjusted trial balance of Dress Right Clothing Corporation, shown here, is referenced to begin the closing process. So the first closing entry transfers the revenue account balances to income summary. Because revenue accounts have credit balances, they're debited to then bring them to a zero balance. After this entry is posted to the accounts, then both revenue accounts have zero balances. This slide on this journal entry here shown is recorded to close the revenue accounts out to income summary. The second closing entry transfers the expense account balances to income summary. As expense accounts have normal debit balances, they're credited to bring them to zero. The journal entry here is recorded to close the expense accounts out to income summary. The third entry closes the income summary account out to retained earnings. After the revenue accounts and the expense accounts are closed to a zero balance, the income summary account has a credit balance equal to the net income for the period, and as you see on this slide, $2,917. So the journal entry shown here closes the income summary account out to retained earnings. After this entry is posted to the accounts, the temporary accounts have zero balances and retained earnings has increased by the amount of net income. Remember that the temporary accounts are closed only at year-end and not at any interim period. Closing temporary accounts during the year would make it really difficult to prepare that annual income statement. So let's look at a question for you. If expenses exceed revenues for the accounting period, the income summary account, A, will have a debit balance after closing, B, will have a debit balance prior to closing, C, will have a credit balance prior to closing, or D, all of these answer choices are incorrect. I'll let you take a minute and think that one through. So again, the income summary account will have a debit balance after we close out the temporary revenue accounts and expense accounts. Revenues are debited to reduce them to zero, and then the income summary gets credited. Then expenses are credited to reduce them to zero, and the income summary account's debited. So then if expenses exceed revenues, there's going to be a debit balance in the income summary account. So now some additional items that we need to do is to record the dividends. An alternative method of recording a cash dividend is to debit a temporary account called dividends. The dividends account is later closed out to retained earnings along with the other temporary accounts at the end of the fiscal year. Next, after we prepare those closing entries and they're posted to the ledger account, we then are going to prepare a post-closing trial balance. Its purpose is to verify that the closing entries were prepared and that they were posted correctly, and now the accounts are ready for the next year's transaction. You see on this slide the post-closing trial balance, and you'll see that the only accounts that show up are the permanent accounts, the accounts in the balance sheet, the assets, the liabilities, and the stockholders' equity section of common stock and retained earnings. There would be no temporary accounts whatsoever in the post-closing trial balance. Cash basis accounting produces a measure that we call net operating cash flows. So this is the difference between cash receipts and cash disbursements during a reporting period from transactions related to providing goods and services to customers. Now, on the other hand, the accrual accounting model measures an entity's accomplishments and resource sacrifices during the period, regardless of when cash is received or paid. Accountants sometimes are called upon to convert cash basis financial statements to accrual basis financial statements, especially for small businesses. So adjusting entries for the most part are conversions from cash basis to accrual basis. Prepayments and accruals occur when cash flow precedes or follows expense or revenue recognition. So an example is on this slide here. If a company paid $20,000 cash for insurance during the fiscal year and you determine that there was a $5,000 in prepaid insurance at the beginning of the year and $3,000 at the end of the year, then you can determine the accrual basis insurance expense for the year. Prepaid insurance decreased by $2,000 during the year, so insurance expense has to be $22,000, which is the $20,000 that was paid in cash plus the decrease in prepaid insurance. So you see here, insurance expense of $22,000 completes the explanation of the changes in the balance of prepaid insurance. Prepaid insurance of $3,000 is reported as an asset in an accrual basis balance sheet. Suppose a company paid $150,000 for salaries to employees during the year, and you determine that there was $12,000 and $18,000 in salaries payable at the beginning and end of the year, respectively. So how do we determine the real salaries expense for the year? Well, salaries payable increased by $6,000 during the year. So salaries expense must be $156,000, which is the $150,000 that was paid in cash plus the increase in the salaries payable during the year. Salaries payable of $18,000 is reported as a liability in an accrual basis balance sheet. When we use these T accounts, it's really an easy approach to convert from cash to accrual accounting. The debit to salaries expense and the credit to salaries payable must have been $156,000 to balance the salaries payable account. For another example using T accounts, assume that the amount of cash collected from customers during the year was $220,000, and you know that accounts receivable at the beginning of the year was $45,000, and then at the end of the year was $33,000. You can use T accounts to determine that sales revenue for the year had to have been $208,000, the necessary debit to accounts receivable, and credit sales to sales revenue to balance the accounts receivable account. This slide summarizes the adjustments required while converting from cash basis net income to an accrual basis net income. We add increases and deduct decreases in assets. Then we add decreases and deduct increases in our accrued liabilities. So let's look at this question. Dan White Draperies maintains its records on a cash basis. During 2018, the company collected $75,000 from customers and paid $21,000 in expenses. Depreciation expense of $8,000 would have been recorded on an accrual basis. Over the course of the year, accounts receivable increased $7,000, prepaid expenses decreased $5,000, and accrued liabilities decreased $4,000. So what would be Dan's accrual basis net income? Take a minute and try to think through how we would begin this process. What we add and what we subtract. So we'll kind of go through it here. Basically, we start with our cash receipts of $75,000. We subtract out our cash disbursements of $21,000, which gives us our cash basis net income of $54,000. Now we're going to need to subtract our depreciation expense, since that is not a cash equivalent. We're going to subtract our decrease in prepaid expenses. Also, we'll add our increase in our accounts receivable, since those were sales, and we'll decrease our accrued liabilities to come up with our accrual basis net income. Let me say that different. We're going to have our cash basis of net income, and then from there we're going to deduct the depreciation expense and the decrease in our prepaid expenses to arrive at our accrual basis. Then we're going to add what our accounts receivable increased during the year, and we'll add how our accrued liabilities decreased during the year to then come up with our accrual-based net income. So a worksheet often is used to help organize the accounting information needed to prepare these adjusting and closing entries and the financial statements. The first step is to enter account titles in columns A and the unadjusted account balance in columns B and C. Then the second step is to determine the end of period adjusting entries, and we enter them on columns E and G. Then the third step adds or deducts the effects of those adjusting entries onto the balances. The fourth step transfers the temporary retained earnings account balances to columns J and K. And then the fifth step is to transfer the balances in the permanent accounts to columns L and M. Now, accountants sometimes use optional entries that we call reversing entries at the beginning of a new reporting period to remove the effects of some of the adjusting entries recorded at the end of the previous reporting period. The purpose of this is to just simplify journal entries recorded during the new period. They're used most often with accruals. So, for an example, the adjusting entry for accrued salaries recorded at the end of July of 2018 for Dress Right clothing was a debit to salaries expense and a credit to salaries payable. Note that if we reverse these reversing entries aren't used, then when the salaries actually are paid in August, the accountant needs to remember to debit salaries payable instead of all of it going to salaries expense. The account balances before and after salary payment can be seen with the use of a T account. So if the accountant for Dress Right employs these reversing entries, the salaries payable account is reduced to 0 and the salaries expense account is reduced to by $5,500. So then when the salaries actually are paid in August, the debit is to salaries expense, thus it increases the account by $5,500. We can see that balances in the accounts after cash payment are identical. The use of reversing entries for accruals, which is optional but easier, simply allow cash payments or cash receipts to be entered directly into the temporary expense or revenue accounts without having to worry about the accruals recorded at the end of that previous period. Subsidiary ledgers is what we're going to talk about here. So the general ledger contains what are referred to as a control account. In addition to a general ledger, we'll have a subsidiary ledger that contains a group of subsidiary accounts associated with a particular general ledger control account. So as you see here, there will be a subsidiary ledger for accounts receivable, and that's going to keep track of the increases and decreases in accounts receivable balance for each of the company's customers purchasing goods or service on credit. After all the postings are made from the appropriate journals, then the balance in the accounts receivable control account should equal the sum of the balances in the accounts receivable subsidiary ledger accounts. Subsidiary ledgers are used for accounts payable, property and equipment, investments, and other accounts. Special journals capture the dual effect of repetitive types of transactions. So, like cash receipts are recorded in a cash receipts journal, cash disbursements in a cash disbursements journal, credit sales in a sales journal, and the purchase of merchandise on account in a purchases journal. These special journals just simplify the recording process in the following ways. They journalize the effects of a particular transaction. It's making it more efficient through the use of specifically designed formats. Individual transactions don't get posted to the general ledger accounts, but get accumulated in these special journals, and then the summary of that special journal gets posted on a periodic basis. The responsibility for recording journal entries for the repetitive types of transactions is placed on individuals who have specialized training on handling those types of transactions. The purpose of a sales journal is to record all credit sales. Cash sales are recorded in the cash receipts journal. Every entry in the sales journal has exactly the same effect on the accounts. The sales revenue account is credited, and the accounts receivable control account gets debited. There's only one column needed to record the debit or credit effect of these transactions because we total them all. Other columns are needed to capture information for updating the accounts receivable subsidiary ledger. So as you see here, during the month of August, the company made 5 credit sales totaling $3,295. This amount is posted as a debit to the accounts receivable control account, account number 110, and a credit to the sales revenue account number 400. The reference SJ1 refers to page 1 of the sales journal. The first credit sale of the month is to Leland High School for $1,500. The sales invoice number for this sale is 10-221, and the customer's subsidiary account number is 801. As we enter this transaction, the subsidiary account 801 for Leland High School is debited for $1,500. The purpose of the cash receipts journal is to record all cash receipts regardless of the source. Every transaction recorded in this journal produces a debit to the cash account and credits to various other accounts. So, because every transaction results in a debit to the cash account, number 100, a column is provided for that account. At the end of August, an $11,750 debit is posted to the General Ledger cash account with the source labeled Cash Receipts 1, the Cash Receipts Journal of page 1. Because cash and credit sales are common, separate columns are provided for these accounts. At the end of August, a $950 credit is posted to the Accounts Receivable General Ledger account, number 110, and an $800 credit is posted to the Sales Revenue account, number 400. 2 additional credit columns are provided for uncommon cash receipt transactions, one for the credit amount and one for the account being credited. So we see that in August, Dresswright borrowed $10,000, requiring a credit to the Notes Payable account, number 220. Also, to the postings to the General Ledger control accounts, each time an entry is recorded in the Accounts Receivable column, a credit is posted to the Accounts Receivable Subsidiary Ledger account for the customer making these payments. So, as you see on August 17th, Leland High School paid $750 on account. So the Subsidiary Ledger account for Leland High School is credited for $750. So, as we go through the review of the accounting process, note that we are going to look at some different exercises to help us understand the various processes. We're going to start with exercise 2.1. Now, the following transactions occurred during March, year 1, for the Player Corporation. The company owns and operates a wholesale warehouse. So it gives us a list of transactions that happened, and then what we're going to do is analyze each of these transactions and show the effect of each on the accounting equation for a corporation. So let's just take the first one. Issued 32,500 shares of common stock in exchange for $325,000 in cash. So let's look at that. What are we going to do here? Our cash increases $325,000, and common stock is part of the stockholders' equity section. So common stock is also going to increase by $325,000. At the end of this transaction, you can see the equation is still in balance because our assets increased And the other side of the equation, the stockholders' equity section, also increased by the same amount. Next, we purchased equipment at a cost of $36,000. We did that because $12,100 of cash was paid, and then a note payable was signed for the balance owed. So what's going to happen in this event is that equipment gets increased by $36,000. Now we used up an asset, cash, and so we decreased our cash because we used it, so we'll credit that cash by $12,100. On the other side of the equation, we took out a loan for the difference. So our notes payable increased by $23,900. That was the difference between what the equipment cost and what we used in cash. So as you see in this example, the equipment increased $36,000, which is an asset. Another asset decreased $12,100, which was cash, leaving us with a change in our assets of an increase of $23,900. On the other hand, since we took out the loan, the equation balances because liabilities were also increased by the same amount our assets were increased. This is an example of our equation is still in balance, but we increased one asset and we decreased another asset. Third, we purchased inventory on account at a cost of $97,000. The company uses the perpetual inventory system. So inventory is an asset. It increased by $97,000. But we purchased these on account, which means we owe the money. So our accounts payable, which is a liability, also increased by the same amount, $97,000. Next, credit sales for the month totaled $150,000. The cost of the goods sold was $75,445. So we've got two entries to handle here. One is to record the sales and the corresponding receivable because it was all on credit, and then the other will be to adjust our inventory and cost of goods sold. So the first thing we're going to do is record the credit sales. Our accounts receivable, since we did not receive the cash, increases $150,000. Also, our sales revenue, which ultimately flows back into our stockholders' equity section called retained earnings, our sales increased $150,000. Then we have to reduce our merchandise inventory. We sold those goods, so we no longer have sitting in inventory the $75,445. So we're decreasing an asset by $75,445, and this expense, cost of goods sold, will ultimately come back and reduce our retained earnings. So again, in this transaction, our assets get decreased and our stockholders' equity also get decreased. Next, we paid $4,400 in rent on the warehouse building for the month of March. What's going to happen here? Well, we used cash to pay the rent, so an asset called cash is reduced $4,400. On the other side of the equation, this is an expense. Expense accounts ultimately reduce stockholders' equity through retained earnings. So as our rent expense increases, or excuse me, I should say as our rent increases, it reduces what's available in stockholders' equity. So in the same respect that we reduce our cash, we reduce our stockholders' equity as a result of paying an expense. Next, we paid $5,100 to an insurance company for fire and liability insurance for a 1-year period beginning April 1st, year 1. So what happens would be related to 2 asset accounts. Our prepaid insurance, which is an asset, increases. But we used cash to pay that prepaid insurance, so our asset account cash will decrease by the same amount. As you see, nothing happened on the other side of the equation, but we're still in balance because we increased one asset and decreased another asset by the exact same amount. Next, we paid $75,000 on account for the merchandise purchased in number 3. Do you see in number 3, we received merchandise and we show an accounts payable. So when we pay $75,000 of that accounts payable, we're decreasing an asset called cash by $75,000, but we also get to decrease our accounts payable by $75,000 because we no longer owe that money. We've paid it. So both an asset gets decreased and the liability also gets decreased. Number 8, we collected $68,750 from customers on account. Now remember, this is customers who purchased items but have not paid for them yet. So now they're paying for them. So in this example, we're going to increase our cash by $68,750. And now that they don't owe us that money anymore, we're going to reduce the accounts receivable, which is also an asset account, by the same amount. Again, we balance at the end of this transaction. 9, we record depreciation expense of $1,000 for the month of the equipment. So, the contra account called accumulated depreciation is affected, which ultimately reduces the amount on that asset. We use this accumulated depreciation account so we can keep intact the original cost of the asset. So when we expense or take a piece of this asset to record throughout the periods of use under the term depreciation expense, we credit an accumulated depreciation account, $1,100, which basically reduces our asset. The depreciation expense also reduces our stockholders' equity section because we're increasing an expense which ultimately decreases our stockholders' equity section. Next, let's look at exercise 2.2. The following transactions occurred during March, year 1, for the Player Corporation. And we're going to do these same transactions, but the difference this time is that we are going to prepare journal entries for each one of these transactions to show how we would record these events. If we issued 32,500 shares of common stock in exchange for $325,000 in cash, we are going to show a debit to cash of $325,000 because assets are debited when they are increased. Remember, assets on the left-hand side of the equation are increased by a debit. On the right-hand side of that accounting equation, liabilities and stockholders' equity are increased by a credit. So our cash gets debited $325,000 and our common stock gets credited for $325,000. Next, we purchased equipment at a cost of $36,000. $12,100 cash was paid, and a note payable was signed for the balance we owed. So equipment is an asset that is getting increased by $36,000. Cash of $12,100 was used. Cash is an asset. It was decreased, therefore we credit cash for $12,100. Last, we took out a note payable for the difference. A note payable is on the right-hand side of the equation. Remember, cash equals, or assets equal liabilities plus owner's equity. Since liabilities is on the right-hand side of the equation, an increase in a note payable is a credit. So this journal entry increases our equipment, which is an asset, decreases our cash, which is an asset, so we credit it, and it increases our notes payable, which is a liability, and we credit that for an increase. Next, we purchased inventory on account at a cost of $97,000. The company uses the perpetual system. Inventory is an asset. To increase an asset, we debit it. But we purchased it on account, which means we haven't paid for it yet. So we have an accounts payable, which is a liability. When a liability increases, we credit that liability. Do you see in every one of these journal entries our debits equal our credits? Next, our credit sales for the month totaled $150,000, and the cost of goods sold was $75,445. This is a two-part transaction. We first show the sales. Now, we did not receive the money, so we debit our accounts receivable because we are expected to get this money. Our accounts receivable and asset increases $150,000, therefore we debit it. And our sales revenue ultimately flows into our stockholders' equity. Revenue accounts are increased by crediting them. Then the next step is we need to get rid of that inventory. So we are going to debit our cost of goods sold expense to increase our expense, and we will credit our merchandise inventory, which is an asset, to decrease that asset. Next, we paid $4,400 in rent on the warehouse building for the month of March. We're going to debit our rent expense. Expenses are increased with a debit balance of $4,400, and we'll credit cash our asset because we decreased our asset by $4,400. Next, we paid $5,100 to an insurance company for fire and liability insurance for a one-year period beginning April 1st. Whenever we pay insurance in advance, it is an asset called prepaid insurance. It will be providing us with a future benefit. So we increase our asset, which means debit it, by $5,100. We paid that prepaid insurance with cash. When we pay and use cash, we reduce our cash, which means we credit the cash of $5,100. Why? Cash is an asset. When we decrease an asset, we credit the asset. Next, we paid $75,000 on account for the merchandise purchased in number 3. So we purchased this merchandise on account, which means we had a liability. We're going to debit our accounts payable. Why? Because think about it. A liability has a normal credit balance. When we decrease that liability, we debit that liability, in this case for $75,000. We reduced our liability by using cash. Cash is an asset. Since we used cash, cash has a normal debit balance, so when we reduce it, we credit the cash. Then in number 8, we collected $68,750 from customers on account. So if we collected money, that means our cash increased. An increase in an asset is a debit to that account. Now, we had that previously as an accounts receivable, which is an asset. These customers no longer owe us this $68,750 because they've paid it to us. So we're going to reduce the asset accounts receivable by crediting the $68,750. Last, we've got recorded depreciation expense of $1,100 for the month on the equipment. We've got an expense here, depreciation expense of $1,100, which is treated as a debit balance. When expenses increase, we debit them. The associated contra account we use for depreciation is by crediting the accumulated depreciation for the equipment, a credit for $1,100. So I'm going to end this lecture and we'll continue on in the next lecture, continuing to go through exercises.